Let's speak to Howard Wang. He's the head of Greater China at JPMorgan Asset Management, which oversees more than $1.3 trillion worth of global assets. Howard, thank you for making time for us this morning. So let's take a look at the property price numbers that we got over the weekend, because you're judging this as a way to see if there's going to be a hard landing in China, right? So what did you make of those figures?
Yeah, I would say the figures are roughly in line with what we were thinking, which is that property measures have been rolled out nationwide. The specific measures are harsher and less selectively enforced in major cities, because I think that's where a lot of the political problem lies in terms of rising property prices. So the differentiation, I think, is really in line with what the market was looking for. Strangely enough, right now, what the market would like to see is they would like to see a cooling of property prices, because the key thing weighing on the market right now is monetary tightening and fiscal tightening by the government.
Okay.
So what you want is you want policymakers to see a good negative impact from their policies thus far.
And would you say they're seeing that right now?
I think they're getting preliminary signs of it, but as we saw with the required reserve ratio hike, they're not getting exactly what they want quite yet, and inflation numbers will probably pick up just a little bit more before they come off. Okay,
so how are you trading then in anticipation of more tightening from the government?
Yeah, I would say that we expect the markets would look forward. We think that the tightening and the tightness of the environment in terms of monetary and fiscal policy is probably at its maximum right now. So we've been building positions all through this process, obviously given the events of the last couple of weeks, a little bit too early. But nevertheless, we think that it's going to be a good environment for Chinese equities, but it'll just take a little bit of time.
That's interesting. Good when? I guess the timeline is the big call.
Yeah, I would say that within the next 3 to 6 months, we expect to see Chinese equities rise, at least in relative terms.
Okay, so let's be specific. When you say Chinese equities, are we talking about those ones that trade in Shanghai or the ones that trade here in Hong Kong?
We would say both, but the ones in Hong Kong are obviously a little bit more linked to what's going on globally.
Yeah, liquid too, as well, and easier to access, some would say.
Easier to access for us. The ones in Shanghai and Shenzhen are actually more liquid, but foreigners generally have very little access to them.
Very little access. Okay, so let's talk also about specific sectors, and namely the property sector. What would you be doing with them? Are you shorting them right now?
We're actually going long them right now.
Oh, yeah. That's a good contrarian call.
Yeah, at some point you have to look at the risk-reward of the stocks, and they're right now trading at very, very wide discounts to net asset value. We think the net asset values, they've already assumed enough of a price decline and volume decline to be realistic. So ultimately, it's the sort of thing you kind of ease yourself into. It's no secret that these are bad stocks and things are going badly for the sector. But at some point, we think they come back in a pretty big way because of where the valuations are right now.
Okay.
However, one does need to be patient. It might not be next week. It might take until next year.
Okay. Okay. What else are you going bullish on and long on as well?
Yeah, we're also taking a close look at, well, number one, we always have, I think, a China consumption overlay built into our funds.
That seems to be the theme.
Yeah, it's a theme. Everyone knows it's good. Things are still going well. We have a lot of department stores, for instance, in our portfolios. The second theme, which is a little more along the contrarian track, is we're also going long certain Chinese materials, namely cement, for instance, because we think that, per your earlier question, that the hard landing is not happening. And number two, that there are enough supply-side constraints and enough strong demand on the other side, basically to keep prices moving at least flat, but probably up for the foreseeable future.
Okay, I guess I'm going to ask something that viewers are probably wondering. What makes you so sure that there's not going to be a hard landing in China? When you look at stocks are pretty much going down week after week, I mean, it's hard to have that much faith and optimism. Yeah,
well, I think I would distinguish two things, which is, it's hard for the Chinese government to hard land, right? Because the first quarter of 2009, that's your Chinese hard landing. Unemployment rate ticks up a little bit. GDP growth is 6.5%. It's not a hard landing viewed in conventional terms. The trickier thing, I think, is the second point, which is there going to be a hard landing in profits? Because ultimately, that's what you're buying as an investor. If you invest in GDP growth in China, you would be long all the time, and you wouldn't necessarily be right most of the time.
People are thinking, when is it going to hit with all these bad loans, all the credit growth that we've seen? When is that going to actually come out to the markets for everyone to see?
Yeah, if it comes, it's going to take quite a while, because I think if you look at, for instance, NPL balances at the banks, those NPL balances are actually going down. Not just NPL ratio, but the actual aggregate amount of NPLs. So, in other words, China is growing fast enough right now for the credit cycle to continue to be supportive.
Okay. Yeah. Well, thank you for that optimistic view on this Monday morning, then. Nice to see you, Howard.
I'll just stay optimistic.
Enjoy the rest of this week. Howard Wang of JPMorgan Asset Management. He's the head of the Greater China team.